floating rate notes. So there are two types of coupon payments. It can be floating or fixed. When you determine a floating rate, there is some link to the market always, right? Because otherwise, how will I determine the float? Like, how much do I have to pay you? It can't be, hey, pay me whatever you like. So you have to link it with something to the market. No, this link to the market is called reference rate. So this reference rate can be set as anything. I can pay you LIBOR. Say I'll pay you LIBOR plus 1%. Or I can even say Nifty benchmark. Now, a floating rate also has limits. That is a floor and a cap. That means the rate in this range, right? You can't have anything going below a floor or above a cap, right? So this reference rate, after you set it, you also set a cap and a floor. You set the floor as 0%, LIBOR plus 1%, let's say. But it cannot exceed this.
Yeah. Okay.
Cannot exceed. So this becomes a cap. Okay. Then the other coupon structures, you also have step up coupon. Rate keeps increasing. What about a credit link coupon? Credit rating of issuer. Rate goes up if credit rating goes down. Rate goes down if credit rating increases. Right? That means you become more trustworthy. So payment in kind is a little interesting. This means that the issuer will issue more bonds. So this helps the issuer. What's a deferred coupon? I think it's easy. You also have index linked bonds linked to. So I'm going to write equity index. Be CPI, commodity. This particular bit linking it to CPI is very common. Inflation eats up the value of the bond, right? To actually reduce this risk, to reduce inflation risk, link it to CPI. Protected security is TIPS. Treasury Inflation Protected Security. What's a contingency provision? So contingency provision is what to do if something goes wrong. Something called embedded options. Call options or put options. Let's say you bought a bond for 1,050. After 1 year, the value of this bond is 1,125. If the market interest rates have dropped, as a company, you can get cheaper financing, correct? If you have a call provision, if you have a call option embedded, you can call the bond. What does that mean? That means you can retire the bond. If the bond goes above 1,100, this can be the call value. So the call option favors the issuer. Put option favors the, if value goes below a preset value, the bondholder can exit. The value was set at $9.25. So if value is less than $9.25, bondholder can exit. You have convertible bonds, warrants, and contingent convertible bonds. So what they did is they combined CO. These are called COCO bonds. What this says is, if there is a contingency, convert the bond. Equity. Favors financial institutions quite a bit. Why? To pay you anything, I can convert your bond into equity, which means the liability reduces. So this is very risky for the bondholder, riskier for the bondholder. What's a warrant? Simple, easier, right to buy shares at a predetermined rate, $70 warrant, right? That means in the future, if my stock increases, let's say increases to $85, right? You will still have the right to buy it at 70. So convertible bond basically gives you the right to convert a bond to equity. A conversion price. Then there's a ratio. Ratio of conversion. 20 shares per bond. Then you have conversion value. You said market price, but the word current is important. This is a threshold.